Good afternoon and welcome to Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. Kelvin Wong, market strategist at CMC Markets, is our guest today. Good afternoon, Kelvin.
Hi, Brian. Good afternoon to you, and good to see you again.
Now, Kelvin, before we get your insights, let's take a quick look at how the crypto markets are performing, and then we'll take a look at regional stock markets. We start with Bitcoin. It's at 21,214. It's down 3.33%. Ethereum is at 1,141.18. It's down 1.43%. Now, looking across to regional stock markets, the SGX is up 0.62%. Bursa Malaysia is down 1.48%. Shanghai is up 1.41%. The ASX All Ordinaries is down 1.09%. The Nikkei is down 0.87%. The Hang Seng is up 1.21%. And rounding up the numbers, we've got the Kospi, which is down 1.83%. Now, Kelvin, still after yesterday's poor numbers, the numbers relatively continue today. What's the reason for that?
Well, because overall, if you look at Asia as a whole, yeah, it's still pretty much bearish as a whole in general. Because number one, tonight later, or in fact, this morning, Thursday, at around 2 a.m. and 2:30 p.m., we have the Fed FOMC meeting, which is pretty key. So later I'll discuss more about that. And also at later part of earlier this morning at 2:30 a.m., which is Fed Chair Powell's press conference, which is equally important as well, because right now potentially he could actually give much more hawkish guidance. So later we can discuss more about that when we talk about this FOMC expectation. But what's interesting over here, we start to see a very clear outperformance on the China-related stock indices, which is the, as you flashed earlier, the Hang Seng Index, which is up close to about 1.2%, and the China benchmark index also up by a similar magnitude.
And that is probably because of some of the positive numbers that have come out this morning.
Yes. So let's take a look at this number. We're going to share a quick calendar. So what we could see over here is the industrial production of China actually surprised on the upside. So it actually recorded a growth in May, 0.7% year-on-year growth versus the previous month contraction of negative 2.9% year-on-year, and even surpassed expectation of a negative figure of negative 0.7. So what we could see over here is it actually indicates to us that, hey, that recent lockdown in Shanghai and Beijing, the choke point seems to be gets a bit of elevation, where a business activity starts to resume a bit of normalcy, and also on top of that, it could be possibly due to the we call it this accommodative policy that's being enacted by China's state planners in the recent 1 to 2 months to actually address this contraction in economic growth that is pretty prevalent in China since the start of this year. But also bear in mind over here is that we can't be for certain that the China economic contraction is now at a potential inflection point where we start to see a major U-turn. Why? Because do not forget over here is that COVID-0 policy in China is here to stay, as being evidenced by last weekend, where we start to see kind of a minor restriction that's being placed in Beijing and Shanghai after a kind of a recent flare out in certain parts of these major cities that was actually being witnessed over the last weekend.
Now, Kelvin, I want to zoom in also then on expectations on the FOMC meeting later today.
Yes.
So
Yes.
Originally, what's been telegraphed is 0.05 or 50 basis points increase,
Yes.
but that's changed.
Yeah, precisely. So let's look at the forward pricing, which is the Fed Funds futures forward pricing, what they are actually pricing in right now based on market expectations. So this is for later this morning, 15th of June. So what we could see over here is that previously 50 basis point was being priced that will lead to the Fed Funds rate to 1.75% to 2%. So that pardon me, yeah. So that was okay. So it's 1.25% to 1.5%. That was initially 50 basis point. So you look at the probability, right, from a week ago, that was 96.1%, and based on the current situation right now, it's actually zero. So what we could see is a 360-degree change from a initial 50 basis point to a 75 basis point hike to bring the Fed fund rates to 1.5% to 1.75% from just a probability of 3.9% a week ago, right now up to almost certainty to 98.6%. Plus, all in all, this is actually due to the red hot US CPI number that was actually released on last Friday. So this actually apparently also happened on next month, which is 27th of July, where we start to see also an increase in expectation of a 75 basis point hike to 2.25%. So you could see over here is that the odds also start to shift dramatically from just 0.8% a week ago to right now 94.5%. Okay, so now the big question over here is that is market jumping way ahead of the Fed? That hey, the Fed will rise 75 basis point. But we got to bear in mind, don't forget over here is that on top of we call it Fed funds rate as a monetary policy tool to actually address inflationary pressure, the Fed also has another tool, which is we call it this quantitative tightening, which is the reduction of this massive $1 trillion worth of what we call it mega bond portfolio that they have built up since the we call it the subprime crisis in 2009. So they already started their quantitative tightening at the start of this month. So that could actually be also an indirect form of we call it monetary tightening policy on top of what we call a direct interest rate hike. So a QT depend on estimates or where what kind of model you use. The current QT quantitative tightening pace could actually more or less be about 20 to 25 equivalent to around 20 to 25 basis point hike. So all in all, what we could see over here is that the Fed itself may not be so aggressive in actually producing that 75 basis point hike as well. And do not forget over here is that in fact markets itself has started to actually do the job for the Fed. Why? Because if you look at this inflationary expectation, forward-looking inflationary expectation, the blue line is a 5-year break-even inflation rate. That means telling inflation rate 5 years from now. The orange line is the 10-year break-even inflation rate, which is 10 years from now. In fact, they are started to inch downwards over the last 2 to 3 days, which in fact telling us that, hey, the market has really done a job by actually tightening the inflationary expectation that's being priced going forward. So in fact, the Fed already provided this hawkish guidance, or in fact, the market has really run ahead of themselves. So the Fed may not be so hawkish after all. Yeah, but we shall see after the today's meeting. Yeah. So Brian, I hope that we still have a bit of time, or do we still have? Okay, so let me very quickly share the important chart of the SPX 500. So this is the SPX 500, a key barometer. So for sure, we know that we are in the bear market territory. But from a short-term perspective, what we could see over here that this steep decline in the last 3 to 4 sessions has really reached a oversold region. And in fact, the downside momentum has started to ease by the signs of this bullish divergence on the 4-hour RSI. So I'll be watching very closely this key medium-term pivotal support level at 3610/3580. If this level managed to hold tonight, later, that means there's no 4-hour close below this level. A break above 3840 could actually start to see at least a shorter relief rebound towards 3980 on the SPX 500.
Now, Kelvin, as always, thank you very much for your technical insights in particular.
My pleasure, Brian.
We've been speaking to Kelvin Wong, market strategist at CMC Markets on Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as Rajhi Bank's social media platforms. Please like and subscribe to our various platforms. Thanks again for tuning in.